Back in June, nearly $2 trillion vanished from the global markets in a single day. The panic was so intense that South Korea's national stock exchange had to completely halt trading. This chart tracks what happened next. After that sudden, violent plunge, you'd expect a prolonged period of caution. Instead, within 3 weeks, the market pulled a sharp U-turn, blasting right past previous record highs, as if the panic had never occurred. When the entire financial system looks directly into a systemic abyss, shrugs it off, and immediately goes back to buying, we have to ask why. It strongly suggests that deep structural damage is being purposefully ignored. To understand exactly what they are ignoring, we can look at a metric Warren Buffett calls the best single gauge of where valuations stand. It compares the total value of the U.S. stock market directly to the size of the entire U.S. economy. This gauge shows that relationship. Buffett warns that when this number nears 200%, you're playing with fire. Right now, it sits at a staggering 238%, pushing higher than the dot-com bubble and any point in recorded history. To get to that number, major tech companies are trading at over 20 times their sales. Not their profits, their gross sales. That math only works out if you assume their current explosive growth rate never slows down. Wall Street analysts and institutional investors have access to all of these exact numbers. They can see the math doesn't add up. Yet the fear of missing out on immediate profits pushes perfectly rational people to look at glaring red flags and decide the old rules of money simply do not apply to them. When financial markets become incredibly complicated, the people paid to monitor the risk often throw their hands up. They develop a blind spot, tick the compliance box, and move on. Right now, that massive blind spot is something called circular financing, and it is quietly propping up the current AI boom among a tight circle of tech giants, with NVIDIA sitting right in the center. Here's how the diagram works. First, NVIDIA invests billions of dollars directly into OpenAI. Next, OpenAI takes those exact same funds and commits hundreds of millions to Oracle to pay for massive amounts of cloud computing power. Finally, Oracle takes that same money and spends it by buying AI computer chips directly back from NVIDIA. The dollars go all the way around the track and land exactly where they started. As we watch this loop speed up, notice the counters. Every time those same dollars pass through a company, that business gets to record it as brand new market demand and fresh revenue. By some estimates, nearly $1 trillion in deals is currently looping around this small handful of companies. To the outside world, it looks like a booming industry, but much of that roaring AI demand is just an illusion created by counting the exact same money 3 or 4 times over. We have seen this exact mechanism before. Back in 1999, Lucent Technologies employed a tactic called vendor financing. They lent new telecom startups the money required to buy Lucent's own equipment. They recorded those internal loans as outside sales. For about 2 years, their revenue numbers looked absolutely spectacular, right up until the telecom startups burned through the cash and couldn't make their payments. When investors finally realized the company hadn't actually earned the money their sales numbers suggested, Lucent's stock collapsed by 99%. This involves massive funds lending money directly to companies, keeping the transactions completely out of sight and off the public books. This chart breaks down the private credit market. Over the last 5 years, AI-related deals made up about 17% of this lending. Now, that figure has nearly doubled, with 33% of private credit issued in 2025 pouring into high-risk AI investments. This creates a fatal logic trap. A huge chunk of this money was lent against traditional software firms the company's AI is designed to replace. Look at how this decision tree plays out. If AI technology falls short of expectations, the tech loans go bad. But if AI succeeds and replaces those tools, it kills the established software companies, meaning the loans lent against them go bad anyway. The financial system engineered a scenario where you lose whether you pick heads or tails. A massive wave of loan defaults is unavoidable, regardless of whether the AI dream actually works. The cracks are already forming in real time. Private credit defaults have climbed to a record 6%, and major banks project that if the disruption accelerates, default rates could surge to 15%. Investors see this data, but 15 years of rate cuts, emergency lending, and bailouts have created what Wall Street calls the Fed put. It is a deep psychological conditioning that makes the market genuinely believe a government rescue is guaranteed anytime things get rough. We felt that exact same false confidence back in March 2008, when Bear Stearns rapidly fell apart over a single weekend. Just like our recent flash crash in June, it felt like the floor was giving way, yet the stock market went right back up. Investors convinced themselves the collapse was an isolated incident, and the scare was over. 6 months later, Lehman Brothers collapsed, dragging the entire global economy down with it. The June flash crash served as a tremor, a warning that often appears shortly before the systemic floor begins to give way. Surviving what follows requires moving away from the crowded tech trades and ignoring the popular delusion that the rules of debt no longer apply.